Hey everyone, my name is John Carvalho. I'm president of Stone Oak Capital. I'm really humbled and grateful that you could join us here today to talk about navigating the current market uncertainties in completing M&A transactions. We've pulled together an incredible panel of M&A professionals to explore how we can get deals done in today's unpredictable environment. We have rising interest rates, we have tariff tensions, we have geopolitical instability, we have market volatility. We really have it all. Also wanted to give everyone on the call kind of a US and Canadian perspective on what's happening in real time. So I've asked two of my longtime dear friends to join me. I have Terry Freeman, head of investments at ATB Private Equity, and then I also have Andrew Sherman, who is a partner at Brown Rudnick LLP. I also have two new friends joining me today. They're both senior directors at Rivron. I have Scott Perez and Fernando Torres. Thanks, guys, for joining me. I'm super grateful that you're able to provide us with your insights on this really important topic today.
Thank you.
Yeah,
Thanks,
just
John.
a little bit of housekeeping before we get started. So we do have the chat box and the Q&A box open. So if everybody wants to make commentary throughout the presentation and the webinar here, we definitely can. If you want to say hi to the panelists and let us know where you're at, you could do that now. With the Q&A box, please keep your questions to the Q&A box. It just helps me kind of manage at the end, and we'll have about 10 minutes at the end of our panel discussion so we can answer all of your questions. Awesome, guys. So we're going to get right into it. Really want to talk about kind of what the biggest drivers of uncertainty are in 2025. So Terry, maybe you being from Edmonton, my hometown as well, maybe you can give us kind of like your lens on what you're seeing as the biggest drivers of deal uncertainty right now.
Well, thanks, John. I'll start with a Samuel L. Jackson quote. I know that scares everybody, but there's no profanity. We have known knowns, we have known unknowns, and we have unknown unknowns. And I think what's driven uncertainty is we have more unknown unknowns than we've ever had. The flip-flopping on tariffs creates an unknown unknown because you don't know what's going to come next and if it's going to be positive or negative. So people are trying to manage a greater set of uncertainties that are not manageable. We can all diligence out the knowns and even the known unknowns to a certain level, but unknown unknowns reach up and slap you in the ear.
Yeah, no, it's crazy that there are so many things that are going on. It's almost like a perfect storm of uncertainty. Scott and Fernando, what are you guys seeing over there? And I know, Scott, you're in Washington, D.C., and Fernando, you're in New York, but maybe give us your lens on what you're seeing around deal uncertainty.
Sure. No, I definitely agree. I think the biggest driver of deal uncertainty right now, to Terry's point, is economic uncertainty, which is largely driven by the trade tensions between the US and its partners, specifically China. And it's been exacerbated by this really turbulent rollout of the US tariff policies. We saw that the S&P 500 shed nearly 12% starting on Liberation Day, April 2nd to April 3rd, taking off the high of 6,100 and entering into correction territory, though it's largely recovered given the 90-day pause with tariffs in China. The culmination of these uncertainties is making it really difficult for buyers and sellers to enter into transactions. So we have seen varying degrees of structural changes in the past. The pandemic, war with Russia and Ukraine, some political instability in Canada, France, and Germany. And we see that there's now some disruption caused by generative AI. The silver lining here is that there's pent-up demand, and we saw an excellent example this morning with Dick's Sporting Goods announcing its acquisition of Foot Locker for $2.4 billion. So I think we need to give the market a little bit of time to price in these new structural changes. Once they are priced in, we're expecting that's going to be a lot of fast followers who want to participate in this next wave of M&A transactions.
Yeah, it's crazy how every little bit of news really kind of impacts the things that are happening in the market, either positively or negatively. And that just adds to all of this craziness. Andrew, what are you seeing? You're in Washington, D.C. as well.
Yeah,
what are you seeing kind of from a U.S. perspective, and not only maybe the public markets but also the private markets?
Yeah, so, I'm going to take us back 6 months, which seems like forever, but 6 months ago, no matter what your politics, people were pretty excited. You mentioned perfect storm of negativity. I would say there was a perfect storm of positivity going into November, December. People thought, oh, we're getting a pro-business administration. We're going to have deregulation. We're going to have tax cuts. We're going to have pressure on the Federal Reserve to cut interest rates. I mean, it's going to be an M&A fiesta. And I think, to go back to Scott's point, the rapidity in which the pendulum swung from a perfect storm to, like, partly cloudy with a chance of meatballs, if you remember that kids movie. And we're still feeling the impact of those meatballs falling on our shoulders and our heads. But, the factors are so many. I mean, we've even seen companies affected by DOGE, by government contracts terminated for convenience, by the rapid shift in DEI policy, the deferment of some of the deregulation, even though hundreds and hundreds of executive orders have been signed, not all of those have been implemented. So there's a difference between activity and results. The impact of deregulation and the cost savings and efficiencies are not being felt yet. Tax cuts appear to be on the back burner relative to tariffs in terms of revenue raise. And back to Terry's point, you can't upset your best friends like Canada, Mexico, the UK, and expect everything to be okay. You can't punch people in the nose and then say, I'm sorry later. That is, the negotiating, position of this administration. And I think that, while it may ultimately be effective, the issue is going to be how much damage is permanent and how much do we have short memories. I mean, so we'll get into it over the course of the hour, but the deal uncertainty is real, and yet deals are getting done. And the pipeline that we have is actually relatively fat, but they're different types of deals. And last thing I'll say is some verticals are highly in favor. No surprise to anybody on the panel, seeing an uptick in AI-related companies of all types. And we're seeing companies like hospitality, restaurant, travel, being not just not on the playing field, but not even in the stadium. I mean, nobody wants to look at them right now. And so I think, to be selective, you're going to get deals done, or you're going to be opportunistic, like the deal that Scott mentioned.
Yeah, Andrew, it's so true that, the sentiment was so positive here coming into the new year, and then it just turned itself 180 degrees, in recent months. So it is cloudy with a chance of meatballs for sure. Maybe just take a quick pause. If people want to, in the chat box, just let us know where they're at, where they're joining us from here today. I think that'd be pretty cool for the panelists and for myself too. So if you want to do that, please do that. So just thinking about on the acquisition side, and taking this really specifically into the M&A, I'll put this over to you, Fernando. How are acquirers adjusting their structures to offset any risk that we're encountering in this volatile environment? And maybe just before you do that, I mean, it's pretty, we can see it's a pretty international crowd and people from all over North America here. So welcome everybody, and I'm really happy that you can join. But yeah, Fernando, maybe let's talk about kind of like adjusting deal structures that you're seeing from buyers, again, to mitigate risk.
Sure. So one of the ways that we're observing that deal makers are mitigating the risk with this volatile market is by using what we call the win the deal mindset, which typically is the notion here is to go away for the traditional approach of deploying resources early in the process, like what we typically see as let's wait see if we get to the second round, or let's wait for the perfect deal. So nowadays, with this more competitive market, because in one side, there is a lot of, we'll get into, there is a low volume of assets in the market, and then you have high cost to finance the deal. So you have a competitive market. So to address that, what bidders are doing is using this win the deal mindset by investing more resources in deal sourcing, investing more resources in doing diligence, which is very common nowadays to see private equity firms completing the diligence early in the process, towards the middle or the third week of an action process, in an effort to lock down exclusivity and win the deal. The other thing that we are using is start using or leveraging AI tools and probably data visualizations and other analytics tools to get, I will call like more insights early in the process. And we're also observing a lot of PE firms bringing their integration teams during the diligence so they can start unlocking more value. Now, something that we see when we compare March 25 and April 25 versus the prior year is that we see an increase in mega deals. Mega deals, we're talking more about $1 billion in terms of deal value. So we're confident that the trend and the rest of the market is going to start following, I will call like these big transactions. So right now is the time to start warming up your M&A arms or M&A work stream. And one of the ways to do that is thinking about, these win the deal mindset and going from a one-time bidder to a serial acquirer.
Yeah, no, that's really great insight and great perspective. So Andrew, with this win the deal mindset, like are you specifically seeing like adjustments in deal structures? And when there's a winner, there on the other side needs to be a loser. So are you seeing that as well?
Well, couple of points. One, I generally agree with your zero-sum comment. I think there are ways to structure still win-win using tools that buyers are using to de-risk, like rep and warranty insurance technically can benefit both parties if there's not too many carve-outs to it, in terms of having the buyer feel a little bit less risk and the seller getting some comfort that, if they miss something minor, not fraudulent or, that type of thing in the reps and warranties, that there'd be coverage. The second thing that we're seeing, and this is interesting, that it's okay, Fernando and I may be seeing two different things. We're seeing more tuck-in deals of smaller size where people are less likely to commit the bigger capital until we get a little more clarity in the market. I'm glad that Fernando's seeing bigger deals because that's encouraging. And certainly Scott gave one of those examples, and there are a few others. But in the middle market practice, we're seeing people taking a little bit smaller bites of the apple, de-risking through slower, wider, and deeper due diligence periods. I mean, it's a little bit love-hate for the lawyers because as a lawyer, you want to see a large volume of deals, but you hate it when the client's rushing you to get it done because you're worried the details will be skipped. Well, guess what? Nobody's in a hurry right now. Like, part of the benefit of this chaos is people really want to get their due diligence right. Deals are taking longer to close, which I know is not good, when clients are in a hurry, but it can be good in terms of making sure that all details are addressed. So I'd say quality over quantity, due diligence periods being longer but a bit more costly, and tuck-ins versus large transactions, subject to Fernando's comments.
Yeah, it's a great summary. Terry, I mean, we're kind of in a similar market in Western Canada here, and maybe more of a mid-market type of deal environment. But what are you seeing? How are you seeing different from what Fernando and Andrew had mentioned around adjusting structures to offset and mitigate risk?
Well, I think in the mid-market, there tends to be a real desire on the part of the vendor to exit. If they're part of the silver tsunami that's wanting to go away and enjoy retirement, they're more willing to not necessarily accept a retrade, but accept a change in structure. So if you look at, when you look at consideration, you look at amount, quality, terms, and all the rest of it, they'll play within the bands of those things. So they may not want to change the amount, but they may be willing to take more VTB because the acquirer, or us as a fund, can't get as much leverage as they once did. I saw one the other day that was quite creative. The buyer really wanted to follow through. They were looking through all of the noise currently, but they said, hey, can you help us with a little bit of risk? You own the building. Will you lower the lease rate for the first 5 years? And give us a chance to, maybe cushion some of the things that'll come out of all this uncertainty. But generally, good people are looking through the noise and saying, okay, I still want to do this deal. Fundamentally, it's right for my business longer term. And to Fernando's point earlier about AI, my prejudice will show because I'm on the board of an AI business. You know, funds are actually using that tool as a driver for value creation when they acquire. So they're not giving it away, but they're saying, okay, rather than sell the firm my AI service, I'll go buy it. I'll apply my concepts, particularly agentic AI, and create value in the process. And I'll do that multiple times so that I create a really exciting roll up that's got tons of value.
Yeah, that's awesome. And Terry, just you said VTB, and for our American friends, that they like to say seller financing, and we like to say vendor takebacks. So
Great.
just
Sorry.
translate there a bit as a
Hey,
deal nerd here.
hey,
Yeah, that's right. That's right. And just want to like step back and just say again, thank you for everybody that's joined. You can see from the chat box that we have people from all around the world, and definitely on both sides of the border. So this is great that we can be providing this different perspective, this global
can't we all
perspective
just get
on deals.
along?
Yeah, can't we all just get along?
Yeah.
That's right. Yeah, I love that. I love that. And we are getting along, and this is great. So moving on here, let's talk about kind of like the sellers now, right? And are they holding the line on valuations, or are they getting more flexible? And Terry, you talked about this silver tsunami. So there's definitely a lot of supply out there of businesses that need to transition. But Andrew, let's talk about that around the sellers and how they're viewing valuations in this uncertainty.
Yeah, I want to key off what Terry said because Terry was spot on. Not only the silver tsunami, but this post-COVID YOLO that everybody, retiring sooner, wanting to sell businesses 10 and 20 years earlier than they thought. And lately, the reality of the chaos, your choices are YOLO or no-go. And no-go means, there is a price and terms at which you'd rather stay and keep running the business for a couple of years and letting the situation calm down. We are seeing, as Terry hinted at, big differences between price versus terms. I mean, I've always said I can pay you $100 million for your business, but if I pay it $1 a year for 100 million years, you may not find that too attractive. You also got to get more creative. I love Terry's example with the building and the real estate and lowering the lease rates. If there's enough, levers to adjust, deals can be made, but people have to be ready to be creative and compromise. You're definitely going to see de-risking I'll use the American term, in terms of seller notes. Earnouts are definitely more prevalent. If you're a seller, don't be afraid of an earnout, just be afraid of a bad earnout. I mean, not all earnouts are bad, just bad earnouts are bad. And if there's enough guardrails and accountability and you're focused on top line versus bottom line, earnouts can actually be very lucrative. We're also seeing more creativity, things like royalty deals if there's IP. There's if you've got the kind of creative team on both sides that you're seeing on the 5 people on this screen, deals can get done, but sellers do need to adjust their expectations. It is a buyer's market in almost every vertical, even parts of AI, even though AI gets the hall pass. And I think that if the parties work together, if they're going to get egotistical and stubborn, the deals will derail. I promise you, 40 years of doing this, they will derail. But if people are willing to be open to ideas like the one Terry threw out with the real estate, I still think there's pathway for landing.
Terry, I mean, you run a private equity group here, and there's just so much capital in the market, chasing deals, and someone I mentioned like quality over quantity, right? So they're probably chasing higher quality deals. So are you seeing that as leverage for sellers with these great businesses to hold the line on valuations, or do they need to get more flexible as well?
I think there is the requirement for flexibility is still there because closing risk is real. And we've had several in the last 6 months fail in due diligence. And some of it is expectations, some of it is, they don't really know how to forecast, the usual suspects. I would say the other intriguing thing that creates a market dynamic that allows sellers to hold the line is the proliferation of search funds. So, whether they're individual searchers or funds, they're getting matched up with these aging out entrepreneurs, so they still have a floor, if you will. It may not be a great floor, because the terms are not great. There's not a lot of cash up front because the search fund or the searcher doesn't have a ton of dough to deploy up front. But it still allows them to say, okay, I've got an out. There's somebody's going to take this over. I'll still get paid, et cetera, et cetera. So that keeps some creative tension in all of that. So it's a very dynamic market.
John, may I add one quick point to
Yeah,
Terry?
please.
Yeah, if you're tuning into this and you're on the sell side, please be aware that these search funds are called search funds because they're not often capitalized. And we've had a few deals derail where the search fund itself couldn't raise the capital that it thought it could. And in the meantime, the seller is in an exclusivity period. So they're, it's illusory. It's not real. Do what we call reverse due diligence. If your lead buyer is a search fund, you got to do some due diligence on access to capital and how quickly they can raise that capital.
Yeah, great point, Andrew. Just circling back on the valuations, Scott and Fernando, what are you guys seeing on valuations specifically for sellers, and are they pushing back if the buyers are coming in and trying to negotiate tougher terms and tougher pricing?
Sure. No, I'll take this one. I think we're seeing two things here. So we're seeing where sellers need to be a little bit more flexible, where maybe they were really waiting on the election outcomes in hopes for lower interest rates, lower regulations, agreeing back to some of the comments stated before. And we're also seeing some expectation gaps where some of the sellers are really hoping for the 2020, 2022 type multiples, but that's getting reset. So the ones who are actually holding the line are the ones who have really compelling sell side stories, and there's sufficient due diligence. And that was something that Andrew just brought up. So we'll kind of delve into pro forma adjustments and how that can help bolster the overall deal thesis. So in practical terms, let's say that a seller has, 6 to 12 months before they're looking to sell assets. They could really start to spin up and identify new business process improvements, or if they have a little bit less time, take credit for the business process improvements that are already in place. And these could be pro forma'd in. The goal here is to create a stronger sell side story and create a little bit more friction between buyers and sellers, ultimately speeding up the due diligence process, since a lot of that's being front run, and then increasing deal value.
Yeah, and I guess I always tell clients that value is just the present value of future cash flows, right? And future cash flows in this market seem that they're going to be challenged in the future, which translates to lower valuation. So definitely can see that reasoning for a pushback on pricing. So Terry, let's move on around the deal terms. I mean, we've already talked a little bit about deal terms and some of the things that you've seen as being creative structures on deal terms, but which deal terms do you find are most under pressure in this market?
Cash up front would be, cash consideration as a component of total consideration is probably the most pressured. I would suggest valuation. There's enough data out there that unless somebody has a unicorn or that's incredibly valuable, they're going to be within a certain range. And unless they're getting poorly advised, they know what that range is going into a transaction, or they should. So it's really the cash component. When we're advising people or when we're trying to exit, we tell all of our investees, don't focus on the multiple, focus on what it's being applied to. So actually build up earnings, run a quality business. Otherwise, what's a multiple? It's just a number. So how much cash can you get out of it? We're working on one right now where there's a pretty big gap between what the vendor wants and what our group is prepared to put up front. So, maybe you have to get a third party, another co-investor in to manage that gap if it's critical to closing, or you do a very, very short-term note. So, 6 months, 9 months, a year, so you can actually generate some cash from the actual operation. You're just not seeing the flexibility from lenders, because if you think private equity firms worry about uncertainty, lenders are double that.
Yeah, definitely a stakeholder in the deal process that needs to be considered in terms of, how deals are getting done and how they're getting structured. Fernando, what are you seeing around deal terms that are under pressure in this market right now?
So probably the main one that we're observing that is getting a lot of pressure is the post-closing adjustments. I feel adding to what Andrew mentioned, earnouts, we have seen over the last couple of years an increase in earnouts. I mean, what typically we're observing is that when you are in a volatile environment, companies typically fail to meet Q1, Q2 in their budget, and they're expecting what we call like backloaded forecasts. So earnouts historically are a really good way to address that and get into a fair agreement between seller and bidder. I feel that here the only thing that we need to be careful is when you have something that is changing that much, especially for the deals that are being negotiated right now, addressing with something similar to tariffs is going to be something complicated. But for sure, earnouts is one of those. The other one is working capital adjustments. Over the last couple of years, the volatility has turned what we used to see as cyclical working capital trends. Now we see working capital that look like this. And when you have that, typically it's difficult to negotiate what is the target working capital and setting the rules for the closing working capital. So that's the other area where we have seen an increase in disputes, and a lot of that has to do with the market. The tier one is going to be reps and warranties. With right now, especially for the deals where the tariffs are being negotiated or where the ESP is being negotiated, the reps and warranty includes those, I will call it those statements where you are representing the state of the business. Now, the environment is changing that fast that there needs to be I will call like an agreement between seller and bidder, how they can address that. So those were the three areas we're observing change into the economic terms.
Yeah, working on a working capital negotiation right now, so know what you're talking about all too well. Andrew, what are you seeing around pressures for deal terms?
Terry and Fernando hit a lot of the big ones. I'll just supplement with some of the more boring legal ones. Risk in an M&A deal is like the children's game of hot potato, and you're throwing it back and forth between buyer and seller till the teacher blows the whistle. And if you remember that game, whoever stuck with the ball loses. And so in a buyer's market, you'll see tighter indemnification terms. You'll see stricter and wider reps and warranties. You'll see de-risk through rep and warranty insurance. You'll see larger holdbacks, smaller carve-outs. I mean, these are all risk changing levers that lawyers use in the documents that buyers don't always get away with what they want in a seller's market and in a less chaotic market. The other thing is there's been a lot of talk about earnouts, and we should clarify, I think the panel's in agreement that earnouts aren't inherently bad. They're bad when they're poorly drafted and sellers don't get what they were expecting. We have been working on a kind of new twist on the earnout that's very narrow, very event specific, very easy to measure. So, if Fernando's selling me his company and he insists that this new product is going to be a fantastic new product and it's going to have great sales, we draft the metric around that specific product and that specific product sales and customer adoption and customer reviews. And then it's actually pretty easy and not to be litigated to figure out whether that metric got met or not. It's these broad-based profitability metrics where there's just too many variables that a buyer that's trying to screw a seller out of their earnout can manage poorly or misrepresent. So please don't fear the earnout, fear the poorly drafted one. And as Fernando said, they can be excellent ways to bridge the valuation gap and perception gap between buyer and seller.
Yeah, great advice, Andrew. I really like that, focusing on as few variables as possible when thinking about an earnout.
Rifles, not cannons.
Yeah. So we touched on this a bit, talking about the debt markets. But what are we seeing right now in the debt markets in the U.S., Scott? And obviously we know how it might affect deals, but give us your lens on the debt markets right now and maybe your kind of where it's going.
Sure. So I'll address this by addressing interest rates, given that they're highly correlated. So we know it's about 4.5% right now, which is considered really elevated as compared to the pandemic era, where interest rates were near zero. So when they were near zero in 2021, we saw over 62,000 M&A transaction on a global basis. But as interest rates go up, to Terry's point, there's friction between lenders and borrowers, and that translates to friction between buyers and sellers. So with higher interest rates, we have a higher cost of capital, and it's a drag on the valuation. So as valuations are a little bit lower, we're going to see less sellers wanting to come to market. And this also might impact the amount of buyers who are willing to buy. And I think we're seeing signals by Jerome Powell that interest rates may continue to stay a little bit higher. He just spoke today and he said, we may be entering a period of more frequent and potentially more persistent supply shocks, a challenge for the economy and for the central bank. So if we try to tease that back a little bit, I think we're going to, again, see higher rates. So where you can win in a higher rate scenario is where you come really well prepared with due diligence to support the overall outcomes. And we could also look at it from the lender perspective. This is a very different environment as compared to the 2008 financial crisis. So there were, significant underlying issues, but we're not seeing those issues right now. And to Terry's point, there's just a little bit more scrutiny behind the lending money. There's a lot of dry powder, but with elevated interest rates and continued volatility, the money's not flowing as freely as it used to.
Andrew, how are you seeing the debt markets? And maybe adding to that, do you see maybe a little bit less kind of bank debt and a little bit more kind of other sources of financing like private equity coming into kind of secure deals?
Yeah, the ratios are definitely changing a bit. I would look at this as two variables. There's access to capital and there's cost of capital. Access to capital in the lower middle market has gotten challenging. Banks are, I think, as Terry and Fernando mentioned, are taking less risk. They're looking for less deal flow. And so no matter what the interest rates may be, if you can't get access to the banks, then it becomes irrelevant. I also think there's a bit of whining. A client said the other day, well, geez, we might have to borrow at 6%. And I said, yeah, but what's your IRR on the deal? Oh, in the 20s. I said, well, then stop whining. I bought my first house in 1987 at an 11.25 mortgage rate, and I got a better rate than my friends. And I survived, and we doubled our money on the sale of the house less than 5 years later. So, cost of capital is relevant. I'm not trying to offend any of the quants on the call, but first you've got to get past access to capital to get the cost of capital. And second, if you're looking at doing acquisitions on the buy side where you got to borrow at 6% and you don't have at least a projected IRR in the teens to 20s, what are you doing? You shouldn't be buying that company in the first place. So I do think it's important. I think it's relevant, but I think there's a little bit of whining going on because we were spoiled by the almost nothing rates of just a short 3-4 years ago. And it is about the rapidity in which the pendulum has swung. And if as soon as you give somebody a taste of 3%, they want 3%, that's all.
Yeah, and there is always a little bit of a trickle down, right? Increased cost of capital affects valuations and return on equities. Terry, what are you seeing in the deal markets? Obviously, on most of your deals, I'm sure you're also bringing in more senior sources of debt. How are you seeing the debt markets acting right now, specifically in kind of Canada?
Well, working for a bank, I have to be careful what I say, but I'm not going to be. I think Canadian lenders are traditionally very conservative, so probably they may give you a bulge to do a deal, but it's going to come down fairly quickly. So that percentage of the cap table allocated to debt is somewhat less. As a result, you see the proliferation of some private debt products, some mezz, some
Venture
sub,
debt.
venture debt, things that I think are a great addition to the market. I think they're appropriate. I think they're a useful tool, and I think it keeps the big banks sharp. I'll give you an example of one. We sold our waste collection business to a group from Manitoba, so out of province, backed by a Chicago private equity firm with a Detroit lender. So, there's lots of money available to do deals, cross-border deals, within Canada deals. You just have to have the right sources, and you have to have some credibility with the financial institution over time to be able to get at that access to capital that Andrew was describing.
Terry, you brought it up cross-border, right? And everybody knows that there's a little bit of tension, between the Canadian and US with the discussion of tariffs. So Andrew, what are you seeing with cross-border M&A today? Any sort of kind of geopolitical, economic climate and what's happening between our countries?
It's the strangest cross-border deal environment I've ever seen. You have brand USA damaged right now at the consumer level and therefore at the acquisition level. I mean, I've heard of Canadian stores marking separate sections for US goods, just so the consumer's aware this was made in the US. And if you want to flip the bird at your neighbor to the south, here's how you do it. That's scary to most Americans, or at least most Americans in the know, because we've had such great relationships, not only with Canada, but with other trading partners around the world. At the same time, this crazy dividend to the M&A market is happening, where we represent now 3 different live deals where overseas companies are looking to acquire US manufacturers in order to avoid tariffs. So it's like the yin and the yang of this tariff policy. Companies from Asia, companies from South America, all anxious to buy US manufacturers because that's, the fastest way they can think of to avoid tariff penalties. And now you're seeing some relief, at least hints of relief, on the strictness of the tariff policies. And so things might just normalize. But I'd say cross-border has slowed on the one hand because we've upset a lot of consumers and governments abroad, but picked up where companies are aggressively looking to buy American as a workaround to the tariff. So it's a very weird time relative to cross-border.
Terry, I'll jump to you and ask the Canadian perspective of this on the cross-border M&A.
So, the impact of currency on your ability to do what Andrew's describing, acquiring US-based businesses to mitigate tariffs, is a challenge. Our currency is weak, although it seems to be, like everything, like every other currency, getting a bit stronger, given the policy to reduce the value of the US dollar. But that is a consideration. As I mentioned, there's still deals happening. But I think it's worth mentioning, because I do a lot of things in the oilfield service space, that there seems to be a shift, and we certainly saw it all over the press yesterday, from the United States to the Middle East in terms of capital availability, the desire to invest, the skill to invest. I've got 4 different OFS businesses. All of them are engaged with MENA parties on different stages of transactions. So where you used to have to go to Houston to get a deal done, now you go to Abu Dhabi. So it's a very dynamic market. It also allows businesses that are not US based, including Canadian companies, to establish in Dubai or KSA and avoid tariffs entirely. So do you care if some of your supply chain comes from China if you're shipping it directly to Dubai? No, you don't. So it allows you to actually circumvent a lot of the impediments that are being thrown up. So it's quite an interesting phenomenon. And the scale of investment in AI and crypto and oilfield services and everything from that market is stunning.
Yeah, thanks for that, Terry. Quickly, Fernando and Scott, what are you guys seeing on the cross-border side of things?
So with regard with cross-border deals, something that historically has been, I would call like a really good avenue for this type of deals is that cross-border deals give access to companies to access new markets. And as the US and probably developed countries experience this period of time where they might have a contraction in the market and low GDP growth, having access to other countries where higher demographic bonus, such as in developed countries, might be a really good way to start adding, growth into the revenue. We also agree, with the impact of tariffs. I mean, we're observing right now that there is to some extent this potential opportunity for arbitrage, as the tariffs are being converted into trade agreements between countries. Having an operation in the country that first negotiate the agreement is going to give you an advantage. So we do agree cross-border deals to some extent have been quiet, but we're still positive that we will continue observing more cross-border deals in the short term.
Okay, awesome. Hey, everybody, always loves to hear kind of like deal stories and real world examples of some of this stuff. So Terry, maybe share with us a recent deal story where uncertainty threatened to close one of your transactions, and how do you navigate through it?
Sure. Well, this one's live. So consumer products business with industrial uses, and we did a lot of diligence, made a lot of good contacts for the proprietor, and it turned out there wasn't a permit to operate the production facility. So that created a great deal of uncertainty. A need for short-term capital that is misaligned with our ability to provide long-term capital. So, we found an alternate, a source of finance, private debt, to step in for a short period of time to cover off that particular need until the market was fully developed and the permits actually obtained. So that's got nothing to do with tariffs, nothing to do with uncertainty. It's just, normal deal, day-to-day stuff that happens. And, we still have great hopes for it. And it's a very interesting business, not affected by tariffs at all because its markets are domestic. It actually displaces an input that's subject to tariffs, transportation costs, and currency issues. So it's a much more cost-effective alternative that can also export to international markets, to China. We want to see it happen, but we got to take these uncertainties out, because if those things don't occur, then you have nothing.
Yeah, and it's hard to work them into any sort of forecast, right? And do you include them? Do you not include them? It's just lots of unknowns.
Time value of money. If you can't sell anything for 2 years, it's very different.
Yeah, 100%. So Scott and Fernando, what do you guys, maybe if you can share maybe a deal story that you've worked on recently around uncertainty and the threat of closing?
So let me take this one. So, when dealing with companies in these days, when they do acquire products that are subject to tariffs, or they have suppliers that are, subject to tariffs, one of the ways that we have been helping them to navigate that from a post-closing standpoint is by negotiating the net working capital closing accounts, by allowing, to calculate that using a hierarchy. So the notion here is that we are going away to the traditional, hey, let's calculate closing statements based on, apply gap, because typically what is happening right now is that the inventory that you're going to get at closing might be different to what you have in the past. So we're using a hierarchy that allows to have specific accounting policies that are going to be used to calculate the closing. And in that way, we are helping, buyer and seller to get into an agreement into how they can negotiate, post-closing adjustment that is favorable. Well, that is, I will say, fair for both sides.
That's super interesting. Andrew, you have any good stories for us to share on deals that have maybe gone sideways just around this uncertainty?
Sure. We're going to go till 4 p.m., right? We've got plenty of time. I mean, you ask a lawyer to tell a story, there's no way you get the lawyer's answering in 2 minutes. Unfortunately, some of the chaos is not tariff related, as has been mentioned. Inside the Beltway here in Washington, D.C., we've got lots of chaos being created by DOGE, being created by shifts in DEI policies, being created by the ongoing budgetary debate between the Democrats and the Republicans. And so at any given time, my practice is probably 20% government contractor M&A driven. Well, we've had several clients who's had contracts terminated for convenience unexpectedly. Other government contractors saw it coming. There's been a big move to either withdraw as a seller until things calm down and chaos is unclear, or some of these contracts could be restored, or to reshift into a more balanced government contractor commercial market balance in terms of revenue streams. But at least 2 deals have derailed for variables completely outside of the client's control on the sell side. They were still in YOLO mode, as has been hinted at before, and YOLO plans got stopped because the revenues had dropped so significantly that they're not going to get the price or the terms they were expecting. I hope it settles down because that's a good 20% of our deal flow. But I'm not sure that it will. I just think even if we get some tariff certainty and chaos, we're going to turn to tax cuts and to other government policies that have direct and indirect impact on the government contractor community. And I think there's a lot of confusion. Many of these government contractors were not committing fraud or overcharging the government. They just happen to be servicing programs that have quickly become unpopular. And with their unpopularity have come the termination. There was no defaults under these contracts. The federal government being the largest customer in the world, it can do things like terminate for convenience, and there's very little, if no remedy.
Yeah, crazy. And you know, it definitely, you know, great stories, great advice on that. So just a reminder to our, just everybody on the call here, we are going to have Q&A here in the last 10 minutes, and we're coming up on that time frame. So if you want to put any questions in the Q&A dialog box, please do so, and then we'll answer them at the end. And then just to get everybody's feedback, how is everybody enjoying the panel? Just put it in your comments. Show everybody just the appreciation for these guys and their insight and their experience. So we'll get to the last kind of question before we get into the Q&A. And this is going to be a two-part question, and I'll ask all of you guys here to answer this. But so part one, what can sellers do to create more deal certainty? And then the second part of that is just what advice would you give to both buyers and sellers entering deals right now? So again, how can sellers create more deal certainty? And then the advice you give to both sides. And we'll start with, let's say, Fernando, please.
Yeah, so I felt that one of the ways that you can add value from a sell side standpoint is making sure that the company invests enough time in creating the value creation story. I mean, bidders want to know what brought the company to the current status, where do they are, and what management can do to add value once they own the asset. So spending enough time to creating that story and then mirror that with the forecast, as you mentioned earlier in the process, in middle markets, one of the areas that we typically see that needs more attention is the forecast, and making sure that sellers have a right forecast story where that management is able to speak to it is critical to secure deal value and also, increase the premium they're looking for.
Yeah, awesome. Terry, what are you seeing that sellers can do to create more deal certainty? And then also, what advice would you give to buyers and sellers in the market right now?
Well, be prepared and be committed to selling. So if you're actually entering into the process, have a data room, have a forecast, have a representative that's professional to actually guide you through the process. Time is the enemy of all deals. So if you're prepared and you're thorough, you can survive a Q of E with good records and all the rest of it, your chances of closing are a lot greater. And let the buyer know you're committed to selling. If this is going to, I might do this if I get a good offer, people are going to punt you to the back of the queue. That's just the way it's going to happen, given the level of opportunities that are there for investors. And then advice-wise, I'd just say be transparent. If it's fine to negotiate hard, but just tell it like it is. Like, there's not a mystery. You're not trying to game somebody. We are a minority investor, so we have to be partners after the fact. So if you're trying to squeeze somebody or get a better result than they are at the end of it, then you're going to be pretty unpopular and you won't do any more deals. So transparency is critical to having good relationships and getting the deal done.
Just Terry, following up on your comment on Q of E, do you feel that or see that sellers are maybe going to market with Q of E's already prepared, or?
There's more of that than there used to be, John, a lot more. I think people understand them. They're not, the boogeyman, and it's a chance for you to actually get your normalizations out there and vetted, and it does speed up the process tremendously.
Okay, I see Scott shaking his head here. You agree with that, Scott?
Yeah.
No, I agree. I think we'll kind of summarize some of the themes that have been discussed by the other panelists, but we could really create a 4-pillar model here. Number one, to other panelists' points, having a robust data room, having strong sell side that supports management's pro formas, and showing that finance, tax, legal, IT are all operating really well. Number two is having a really strong M&A advisor who could help with positive deal momentum, increasing the pool of qualified candidates and buyers. Number three, wearing my accounting hat, is ensuring that the financial statements and overall accounting is in order. Having audited or reviewed financials at the ready is extremely helpful. Making sure revenue recognition is appropriate, and remediating any known accounting issues that there might be. And going back to Fernando's point, it's really important to have strong forecasts that are based in the company's operational KPIs. To Terry's point, the middle market has difficulty with forecasts. So we want to avoid situations where the investment bankers are coming in, creating unrealistic forecasts that management can't speak to or stand behind. And it's important that we ground the forecasts in KPIs that management uses, and there's actually a track record of adhering to performance.
Yeah, awesome. So Andrew, same to you. Maybe just tell us how sellers, in your view, how sellers can create more deal certainty, and then also what advice would you give to buyers and sellers trying to enter into deals right now?
Well, my fellow quants on the panel have already made a series of excellent numerical points. I agree with all of them. Robust VDR, getting the Q of E done early, populating the data room before things are missing from buyers. So I'm going to go a different route. I've always believed that numbers follow, they don't lead. So let's go to the human side. It's getting harder and harder to demonstrate to buyers that you have a strong culture, employee engagement, work from home. I mean, people don't even show up at work anymore unless they're mandated to. So how are you going to demonstrate to a buyer that you have an engaged workforce, an innovative workforce, a collaborative workforce? I've seen some PowerPoint decks. They're leaving the people issue out of the deck completely. And, last time I checked, till humanoid robots take over all of our jobs, people are still a pretty damn important part of the deal. So I would say if you want to increase deal certainty, what can you do to tease out the strength of your culture? Follow Terry's advice. If your culture is not strong, don't make it up. Don't pretend. But culture, engagement, work from home, collaboration, innovation, all those are still very important. Those are intangible assets to a buyer. Advice for buyers and sellers: resilience and patience. Everybody else has said all the good ones like choice of deal team, resilience and patience. And back to Terry's point with the lease and the building, creativity. We're not going to get deals done if we're not all capable of thinking outside the box. Okay, Q&A.
Yeah, and having great advisors like everyone on the call here, great deal makers like everyone on the call here, just increases the chances of being more creative and finding more collaborative ways of getting deals across the finish line. So appreciate that, Andrew, of you recognizing that we're getting into Q of A now. We have a lot of good questions here. So just getting through these, there's a couple questions just around earnouts. Maybe we could talk about what makes a good earnout. We kind of talked about some of the specifics around it. But Terry, maybe I can ask you to start. What are you seeing would make kind of a good earnout, or how are they being structured differently now in this environment than you might have seen in the past?
Well, I've been subject to an earnout for businesses I've sold, and I've, obviously imposed them on people when I'm buying. So I think the biggest thing is controllability. So to what level are you going to allow management to control results going forward, assuming if you're doing a roll up, if you want to do other M&A and do things that screw up their ability to make it happen, then you can't do that because that's a bad earnout. So make sure that it's structured around a level that they control, whether it's revenue, gross margin, EBITDA, net earnings. Just pick the right one. Make them a limited time. Things are moving so quickly in the world today. A 3-year earnout seems like forever. And it'll, as much as we love them because it reduces risk, and also put handcuffs on the business, because you can't do things to adapt, because you're going to screw up the earnout. So short term, controllable is the best result right now.
Andrew, you want to add to that?
Yeah, I think guardrails and accountability. I think Terry did a great job in terms of the kind of integrity of the earnout and the downside of the earnout from the buyer's perspective of putting some handcuffs on certain metrics. I love this idea of a more narrow earnout so that, you know, maybe only the handcuffs are on part of the business or on a given event. And, you know, look, if you're not a fan of earnouts, look at some of the alternatives to earnouts: seller financing, taking debt paper back, royalty deals on IP. You know, there's other tools in the toolbox. It doesn't always have to default to an earnout, but to make a good earnout, there should be certain ability of outcome, predictability of outcome, and enough accountability, whether the seller's still employed by the company or not, that they don't have to litigate it to get it right.
It's VTBs, right, Andrew?
Yeah, exactly.
Yeah, just kidding. Fernando,
And the Oilers are going to win the Stanley Cup. So look at that.
Knock on wood.
Who says there's no diplomacy by Americans towards Canada?
Fernando, if you want to add to the topic of earnouts here.
Sure. So from an accounting and finance standpoint, what is important from earnouts is to make sure that we delineate how it's going to be tracked. I mean, oftentimes, you know, if the earnout is measured on revenue or adjusted EBITDA is not a term that is defining GAAP. So we need to make sure that sellers and buyers agree to how it's going to be calculated and make sure that they track that through the process. Now, there is also, you know, some add back from an EBITDA standpoint. So there is a need to invest time during the diligence to understand, you know, how it's going to be calculated and collaborate, you know, with the legal work stream to make sure that is properly documented.
Yeah, great. Thank you for that. A great comment just came in, you know, other methods of de-risking. Do you guys see, you know, just changing in kind of ownership amounts, like more minority investments versus majority investments, or more strategics versus private equity? What are you guys seeing? And Andrew, I saw you raise your hand there. So
yeah, because we almost ended the webinar without mentioning this trend, which has been huge in terms of de-risking, and that's management rollovers. You know, if I'm buying Scott's company and he insists this is the greatest thing since sliced bread, another way he can prove his commitment is by rolling over some of his purchase price into a management rollover. Now, sometimes that's hard to do structurally, depending on the buyer, if it's a public buyer. But, you know, there are ways to demonstrate. Remember, earnouts are a form of accountability. I say X, I'm going to hold you to doing X. But there's other ways to create accountability, and management rollovers are definitely on the uptick, and it's another form of accountability.
yeah, Terry, I mean, your fund, you know, ATB private equity does only minority investments. So are you seeing an uptick in, you know, more people kind of exploring that versus an outright, you know, majority sale?
Yeah, I think a lot of sellers enter into a process thinking they can exit at 100% and quickly realize that they hate earnouts. They still love their business, so why not own part of it? The last investment we did, the owner rolled over 30%, which was a significant amount, and really kind of sealed the deal for us, because we were part of a private equity syndicate and hadn't done the initial contact with the business itself. So that gave us a lot of comfort. So it's definitely happening.
Yeah, great. Scott, do you have anything to add on that?
So we are seeing more rollover equity in some of the deals that we're helping from an OBS perspective, opening balance sheet. So all those comments track.
Yeah, awesome. Well, hey guys, we're coming up on the hour here. I appreciate all your guys' times and insights. Everybody that's joined us today, thank you so much for taking some time to listen out to us. I hope you found the information and the content really valuable. I know I did. So guys, appreciate your time. So grateful for this, and we'll definitely try to find another opportunity to do it again.
Thank you.
Thanks, John.
Okay.
We
Take care.
love you
Great day,
guys up
everybody.
north. We love you guys. I don't care what anybody says.
We love you guys too.
Okay, good.
Thanks, everyone.
Take care, everybody.